We've got the management of ING Vysha Bank with us now on the show. Shailendra Bhandari, the bank's chairman and managing director, joins us. Shailendra, let's start with a view on the liquidity situation. Now, in spite of the CRR cut by the RBI, a number of banks continue to complain that cash is still very tight. What's your take on the interest rate situation and the outlook over there?
So you're absolutely right. Liquidity is tight. The Reserve Bank has a stated policy of keeping the system roughly 1% in deficit with regard to total deposits, which means that they would like to see a daily LAF borrowing of around 60,000 crores. The number that we are seeing is 3 times that. So clearly that is substantially over the targeted amount. Most of the market was expecting the Reserve Bank to drop rates in April. Since that, there have been a couple of data points. There's been the recent index of industrial production, the IIP number. There have been, some concerns on the fiscal deficit. Having said that, we as a house, our economists, still believe that there is a strong likelihood that the Reserve Bank will cut the rates by 25 basis points in April and probably follow through in the course of the next financial year with a total cut of 75 to 100 basis points.
Now, you did recently raise your deposit rate for some of your short-term deposits. How tight is the liquidity situation? How long do you see this tightness continuing to stay in the market?
So part of the raising of short-term deposits was a realignment, because most of us were offering rates which were no longer in keeping with the fact that the overnight repo rate is 8.5%, call money is 8.5% to 9%. So a lot of it was a simple realignment. The other thought also was that on the one hand, the customer should do better if they want to give us better, places for short-term deposits. But the other is that honestly, as a bank, given the outlook that interest rates will start falling sometime, whether it's in April or shortly thereafter, we don't want to lock in at very high rates for the long run. As you know, about a few weeks ago, the CD rates had crossed 11%, 11.5%. In our opinion, borrowing at those rates for the long run did not make sense. So some of it was basically, I'd call it a smoothening of our yield curve.
Afternoon, Mr. Bhandari. Now, a number of banks have started bringing down the rates on certain loans. Is there a similar plan at ING SA as well to perhaps provide some relief for the customer and also to help your credit growth?
So some of these obviously, are more statements than anything else. I think banks have reduced, for example, student loans and some such loans. Similarly, because in this quarter, a lot of priority sectors people have looked to put on priority sector at lower rates. But the bulk of loans for every bank now gets priced off the base rate. I would not expect banks to change the base rate unless there's a clear policy directive from the Reserve Bank. I would believe that if the Reserve Bank were to give such a directive, most banks would then reduce the base rates. So, for example, if there was a 25 basis point cut in the repo rate, I would expect something similar thereafter.
And where do you see your margins settling at this year? What's the outlook for margins going into FY13?
So our margins year to date, our net interest margins are 3.3%. There'll obviously be some amount of volatility. Having said that, we have been steady at around 3.2 to 3.3 for the last few years. And we're reasonably comfortable that leaving aside a few basis points, our margins would stay at these levels.
Right now, Shailendra, what kind of credit growth do you see a bank having ended the year with, and what is your sense on credit growth going into the current financial year?
The only forward-looking guidance we give there is that we will do better than the market and we'll do it with better quality. As of December, our credit growth was around 22.5%, and that's about as much guidance as I can give.
Also, in that case, tell us how asset quality has been holding up for ING Vysha. Are there any key sectors that are beginning to see stress at this point in time? And what kind of requests have you seen for CDRs in the fourth quarter? Has there been a rise in it?
So firstly, in terms of asset quality, one of the things that we have not done is we have not lent to industries like airlines or project finance or state electricity boards. Having said that, the system is seeing stress because high interest rates, a slowing economy does cause stress. We have not seen too much stress as yet, but obviously there's no reason to get complacent because this is a troubling environment. In terms of CDR, well, firstly, we don't do bilateral restructuring. The only restructuring we do at all is if it's part of a CDR. as of now, we have not seen any unusual build-up in requests.
And finally, if you could just walk us through your fundraising and expansion plans.
We raised money last year. We did a QIP last year. We don't need money this year. We probably don't need money next year other than Tier 2.